We know it's early in the earnings season, but what can we say about it at large right now?
No, I think what we can say is that the bar was really lowered over the past few weeks for the earnings season, both for the fourth quarter as well as for 2019 as a whole. So the market is taking as a relief that actually earnings have come in a little bit above expectations, and CEOs have been confirming this trend that we agree with, which is that there's slowing growth but no recession. So I think it's been a good confirmation coming off of a very pessimistic, low expectation end to the year.
Barry, coming out of December, people said 2,700, 2,750 would be resistance. Is that exactly what we've seen?
Yeah, when you have real interest rates, which is your interest rate after core PCE inflation, cross above zero, as it just did in the last several months for the first time in 10 years, your price to earnings ratio is going to stabilize. And after a sharp decline last year that offset most of the earnings growth from the tax cut. But yeah, we're looking for 165 of earnings this year against 157 last year. The street is at 170, down from as high as I think 178 last summer. Earnings are still under pressure, but I agree with Bob Pisani that there's not going to be an earnings recession this year. It's more a risk in 2020.
Barry, your full-year target for the S&P is 2,750. That's less than 120 points away from here. What would it take to make you more optimistic?
Yeah, as I mentioned, at a real interest rate of between about 0.5 to 1.0%, which is a reasonable expectation for this year if the Fed is fairly cautious and inflation doesn't tank, then you're looking at something like 160 times 16 provides really good support at 2,550. And some of these estimates you see out there at 2,900, they're assuming 170 times about 17. I think what I'm worried about is the earnings growth is going to be a little slower than expected. We're going to get weak global GDP in the first half. The capital spending outlook is poor. Buybacks are a difficult comparison on a sequential basis. And the S&P earnings are more cyclical than the general economy, and we've seen commodity deflation. So I'm happy being about $5 below the street, and there is some downside risk to my estimate, which is what's concerning me on getting to that 2,750.
Gabriela, that commodity deflation seems to be a key part of the story. I know it's something I'm watching with some of the industrials as they report over the coming weeks. I mean, you look at aluminum prices, they're actually down double digits now over the past year. It's a similar story for some of the other industrial commodities. Obviously, we've seen it with crude as well. The fears around tariffs on some of these raw materials prices, are they already baked in?
I think so, and I do think that what's been moving some of these commodity prices over the past couple of months has been more that fear of the global slowdown. And in particular for some of those more industrial metals, the concern around Chinese growth. Now, we do acknowledge certainly China is slowing, both structurally as well as cyclically, but we do take a lot of comfort in the fact that they have been implementing a lot of stimulus measures over the past few months, and they're still set to do more, and especially on the fiscal side, things like infrastructure spending that should help some of those more industrial related commodities. So I do feel like there's a little bit of pessimism reflected there in commodity prices, a bit of a fear of a too strong of a global slowdown, especially in China. We think there's going to be more of stabilization over the next few months.
Barry, do you think a potential trade deal between the U.S. and China is already baked in here or not? I mean, how should investors be thinking about that, given the fact that we've had so many sort of conflicting headlines on the topic?
Yeah, when you think about it, it's interesting. When the Federal Reserve turned up the heat last year, they pressured not just the U.S. administration, but they pressured China and the emerging markets through the currency and the global growth outlook. So in effect, the Fed has forced both parties to come together, and it made a deal more likely. The devil's going to be in the details in terms of compliance and extent. And because the president retains enormous trade powers that were given to the president during the Cold War, no president of any party is going to give up those powers. So we're going to have trade conflict as an enduring theme for at least 10 or 20 years. But as far as a short-term ceasefire, yeah, that's increasingly likely, and I think the market recognizes that.
Finally, on the consumer, Morgan Stanley hasn't had a buy on Walmart in 4 years. They go to one today, arguing that the spending funnel from the consumer will constrict as income growth slows down. Given that, are you in a How are you feeling about defensives versus aggressive consumer names this year?
So we think that really the consumer is the strongest piece of the economy. It's really what's going to fuel growth in 2019. Some of the commodity deflation we were speaking about, the energy price decline, that's a really good tailwind here for the consumer over the next few months. So we actually feel very strong about the consumer. More broadly, we are not in the defensives camp yet, and exactly because we do not expect a recession, we just expect a slowdown. So we're much more in the cyclical value camp. A good mix between still a good tie to the economy, but also a little bit of income growth expected there as well. So not full on defensive.